Hey everyone, it's Evan here from the Trade Risk on Friday, March 23rd, here with a weekend market recap video. We're going to cover all the major markets, the current market environment, and then finish off looking at some sector analysis. So it was a brutal week out there for stocks. The NASDAQ fell over 7% on the week. I think that was the greatest fall in at least a couple of years. I think we might have eclipsed the biggest fall in 2015, which would bring us back all the way to 2010, since we've seen declines of this magnitude here for the NASDAQ 100. We also had the S&P 500 making new weekly closing lows for the year for 2018. But there is a little bit of light at the end of the tunnel. There is some silver lining here. The NYSE AD line, cumulative AD line, is showing some signs of positive divergence. Probably not enough to jump in right here and buy blindly, but something that's interesting and we're going to look at in this video. So stick around, lots to cover for this week's market recap video. All right, we'll kick things off here with the S&P 500. This is the cash market. This is a weekly chart of the S&P 500. Each bar on my screen represents exactly 1 week worth of trading. And we're still looking at that S&P 500 because the SPY ETF, that very common SPY instrument that everybody likes to trade, did go ex-dividend last Friday, $1.25, skewed to the downside. Those charts likely haven't quite balanced themselves out, although arguably, given the fact that we did drop 6% this week, that 125 to the downside doesn't change a whole lot to this picture given such the dramatic move. Regardless, we'll here look at the cash market. 164 handles to the downside this week, 6% lower in the S&P 500, breaking support, breaking trend, losing moving averages. Risk happens fast, and we really saw some acceleration selling this week. First time since February, this early February drop here that we saw in the market. It's been more or less sort of a quieter, kind of drifting higher type of market until this week, of course, when we see what has occurred here in terms of damage. Really, it's this picture we talked about in our midweek video. We showed this outlook here, this sort of framing of the structure of the market here, looking like it was potentially forming some type of bear flag here with this weekly impulse leg lower, and then this kind of this push higher, failed right around the 60%-ish retracement. And now, as we talked about in our midweek video, we wanted to see this lower trend line hold. At the time of the video, it was holding, but surely, 3 days later, fast forward, you can see we have just completely cut through this trend line here on the weekly chart and lost these moving averages. So now really you start to look at this longer term trend. This is a picture that we had drawn here much earlier in the year when we initially saw that move. And you could draw this a little more precisely, but essentially from the 2016 lows, this intermediate to long-term trend here is now very much back in question, and you could say we are basically at it given the close that we saw here in the S&P 500. We bounced from this area. The 200 period SMA was right in that same vicinity. We saw this bounce, which led to this about 60% or so retracement to the upside, and now we're breaking back down and coming back into these lows and to the ultimate sort of price lows here from February the 9th of earlier this year. So high stakes zone. Clearly the sellers have momentum at their back right now, breaking through all of this support. This is one of those knives that you have to be careful if you're trying to go out there and catch right now, given the fact that there is so much technical damage done this week, and given the fact that we just seem to be accelerating lower to the downside. We're going to talk about some more specific levels here, but when we look at the daily chart now of the S&P 500, you can see this yellow line at the bottom of my screen now is that trend line we just drew from the 2016 lows. And just take a look here at these past 2 days, just some ugly kind of range expansion, volatility expanding to the downside here on Thursday and Friday. And, really, our first sort of hints of this action was how we started the week. So if you watched our midweek videos every Tuesday, and we talked about specifically the Qs here. Go back to this first board, and this was sort of the first kind of hat tip at the weakness that we saw this week, was this gap down right here to start off the week on Monday, 2% lower in the Qs. Basically, the thought process being from last Friday's video, we wanted to see this upper level support around 171 hold. We did not want to see volatility expand at this level. We didn't want to see some big selling come in, and we got exactly that to start off the week, and it created this island reversal here, this island top reversal, where it trapped a bunch of supply from the gap higher on the 9th of March, and now the gap lower from the 19th of March, basically trapping all of this supply in here. And then we basically had gone sideways, gap down again, and continue to accelerate lower. So a really fast unwind here of price action and technical damage. But when we look here at the S&P 500, there's a few things across all the markets. Really, there's a few things I sort of want to point out here as we sort of lay out both cases. So let's continue with the bear case first for a moment. Breaking through support very quickly back to these prior lows here. This is a dangerous spot, right? We basically have these lows here from February. The wick all the way down here around 252 is the ultimate low. That is a price reference for us now to pay attention to. But we made new closing lows on the week, almost new closing lows on the day, but it looks like the 8th of February, we had a lower close around 257.63. We closed at 258 here on Friday. So this is the spot where you would like to see this market base out and try and form some type of structure here, some type of double bottom, if you will, between this 253 to 257, 258 zone, right around this level. If we start to break down through this level, you know, all bets are off. It gets really ugly there because you can start to project some measured moves from this initial leg here, which would probably get us down closer to the 240s. Again, not saying this is happening next week or in the next few days, but if we continue to see this market violate support and base and then flag out and then sort of break down, we clearly have some worry, you know, some trouble on our hands in the foreseeable future. So, you know, nothing real pleasant to say here in the short term. Yes, we are overbought. So, oversold to the downside. Lots of metrics here, depending on what you want to look at. Basically, everything is saying we are oversold in the short term, but given the fact we have sliced through all this support, sliced through important trend lines, it doesn't mean a whole lot. It's not enough of a reason to buy the market by itself just because we're oversold. When we start to, really enter into these vicious sort of, sell rally or sell waterfall sort of moves, we would expect that the market persists in oversold territory. That is the normal, not the exception. So let's talk about the sort of optimistic side here, or let's start to look at some clues here to try and help us understand when we could start to allocate some capital here. And of course, everyone's time frame is different. First thing I want to look at is the advanced decline line on the NYSE. So here's a stock charts chart here, NYAD. I'm looking at the cumulative AD line for the NYSE. That's the top pane here. And notice the last time, notice from February, the lows here from the 8th, we were down at this, the actual number, the numeric value there is not really important, but we were down here around 15,800. Notice where we are now, all the way up at, this is actually in hundreds of thousands. So, regardless, 30,000 or so higher here, and just notice the slope of where we are in this indicator. And now if we scroll down here, take a look at the NYA, which is the NYSE composite index here. And notice we are actually breaking to new lows today as of the close here on Friday. We have broken below the pivot low from the 6th. So we're making new lows, but look where breadth is here in terms of the advanced decline line. We actually see a positive slope, so positive divergence here in terms of market breadth. Looking at the AD line, that basically in the AD line, for those of you who are unfamiliar, basically treats every single stock the same no matter what size you are. So whether you're $700 or $900 billion Apple company or you're a $100 million biotech company, your vote in this weighting here is 1 in both cases, and whether or not you're up or down, that is how the vote is casted. So that is constructive developments there. Again, it's probably not advisable or enough of a reason by itself to go buy the market right here, but if you start to get some other conditions lining up and your strategy and your setup, you know, these are clues to kind of put together the market context and form a trade decision or plan in that fashion. So something that is interesting there, I think, is one sort of optimistic development there. I mean, volume here on this second leg lower, notice it is not as high. We're not seeing as much as heavy volume as we did see in early February here. We were trading, you know, almost 300 million shares for a few of these days in here, and notice we're about half of that on this recent action here. So volume is lighter, and if we go to the VIX as well, we look at the spot VIX here. Notice we are well off of the highs here from February as well. We were seeing, you know, north of 37. Again, there's probably a lot of other funny business going on with those inverse ETNs blowing up and, you know, some forced selling or what have you. But regardless, we are still at a much lower level range than we were back in February. So there are some clues here to say that maybe we have some divergences. We have some clues that this retest is going to be something that can hold. Again, not advisable to necessarily buy it blindly. I'll let you guys manage your own trade executions, but those are things to sort of think about. So that, I think, you know, really it sums up my thoughts here for the S&P 500. I think it's a trouble. You know, it's a market that we want to respect the risk here and the fact that we violated all this support and all this technical damage, and you should be proceeding cautiously here for you know, for the foreseeable future. If you're a tactical trader and you're taking your shots, you know, very nimbly, then of course, you know, manage your risk and hopefully you have the experience in doing that. Otherwise, I think it's a time to certainly sit on your hands and wait patiently. Now, the Russell 2000, I think, was interesting, and this is something that even caught me, or I gave even a little too much credit to this week, was the Russell prior to Thursday was holding up pretty darn well. I mean, this was what the action looked like here on the Russell 2000 on Wednesday of this week. We were still holding above this critical 155 level. We were holding above a rising 8 and 20 period exponential moving average here on the daily chart. It had an uptick in volume. You saw our green session here on Wednesday. We pulled off 2% off of highs. There's sort of a lot to like here on the Russell, but the rest of the market was telling a different story, and it was almost of who's going to win out here. Is it the Russell or is it the rest of the market? Clearly, we know the rest of the market ended up having it right, and we saw the Russell really unwind here into the end of the week. It was holding up. It couldn't quite hold on to those gains, and again, not quite as, you know, we're not back to the February lows here like we are in the S&P 500. So there is, again, a little bit of outperformance there in the IWM, but still, again, it's pretty messy here as well. The selling came in. Got to respect it. We're back to this level, which again could see some bounce, could see, you know, a bit of some buyers step in here, but we got this trend line and this level in this general area. So again, it wouldn't surprise me to see a little bit of a bounce here, but technically structural damage has certainly been done. And finally, the Qs. I know we're spending a lot of time here on the market environment, but there's a lot to talk about. The Qs, you can see, again, really unwinding this week as well. Still above the February lows, still above this trend line. 156 here is a prior level. So again, maybe a little bit lower next week into this for a short-term oversold bounce for you tactical traders, right around 156.50 or so. That could be an interesting spot. But for now, I mean, this series of gaps and drops to the downside is certainly not action that you would want to really feel comfortable layering in exposure here in the NASDAQ 100. 500. There's just a lot of structural damage there in the short term. There will definitely be bounces, but again, a lot of damage there. So let's, I think that's everything I wanted to cover. Let's get into some other markets here. TLT, bit of a, crisis alpha asset, as they like to label it, did see some upside follow through this week. Nothing too convincing. It was up 30 basis points. Arguably, you could have expected more there in a market that unraveled 5% or so on the week. But not, regardless, TLT is holding in there. It did get beat up for December and January and into early February, so it is in that recovery state. And short term, it is back above the 8 and 20 period moving averages there. So let's give the credit to at least the short term trend for you short term active traders to the upside. Still longer term, still in a tough, difficult spot. We'll go to metals next. We'll go to GLD. So GLD did see some rotation this week, 2.42% to the upside. Basically had a little bit of an outside reversal day, kind of peaked below last week's lows here, and we rallied above. We took out last week's highs the week before. So we took out 4 weeks highs here and closed pretty close to the closing highs, certainly on a weekly basis here for GLD for 2018. And this was a tricky move this week. Right in here, Tuesday was enough of a day where it was still kind of, really trying to shake out those longs here in GLD. Thankfully, I was not one of them that got shaken out, but certainly was close on these lows here to throwing in the towel on the long position that we had. We've been talking about it in all the videos, but got long here on Thursday, the 1st of March, and battled through a lot of chop in here. But so far now, it looks like this is paying off. We did scale a bit of profit here on Friday with this gap higher. We took some profits here at the top end of this range. We still have actually the bulk of our position on. Just want to respect the fact that this is resistance here in GLD, but I do like the developments and continuing to hold sort of the core position in GLD, looking for a move higher. So we are long and looking for that to continue. I like the pattern here on the weekly chart. We just really need to get above, say, 128, 128.50 or so, and GLD could see some nice moves to the upside. Silver, also getting its act together this week, pushing off of those lows, 1% to the upside. It is still in a messy area here, but if we can start to hold up at the top end of this range and start to rally above 1575, really 16, getting back above this, this heavily traded level and influential level up here around 1590, which is still a ways away. Silver, bulls would really just want to see us start clearing above all of this supply in here. I think that's what we want to see. Good developments this week. It held support again, very tricky, undercutting recent lows, reversing sharply and bouncing. Let's see if they can carry us forward higher into next week. Commodities, USO, super strong this week as well, 6% to the upside. Basically, the S&P 500's loss was oil's gain here. New weekly closing highs for 2018, for 2017, and for 2016. So multi-year highs here for USO. That is constructive there. Short-term trend now is certainly convincingly higher here, a bit extended and coming into this old resistance area. So tough to chase, but short term, again, bulls very much in control. If you saw some type of fake out action, a sharp drop back below 13, maybe you get some false breakout double top at play that you very nimble traders could latch onto. But for now, I don't see the reason to fight this. And natural gas, which was also a position we had on, luckily to the short side, was something we covered up this week. This did not participate in the commodity rally this week, 3.5% to the downside, continuing its sort of breakdown from the day of the 15th here when we broke trend and this horizontal level. That was when we got short some natural gas. We covered a piece here on Monday, and then we covered the rest basically exactly where it closed. So we no longer have this position here on Friday. We closed out the rest of it, playing it via DGAZ, the 3x inverse ETF, could still certainly weak, but I'm fine with capturing that short trade there on the inverse ETFs for a quick tactical swing trade. So that's natural gas, oil, gold, silver. I think that's everything for the major markets. Let's get into some of the sectors. I mean, basically everything looks horrible. I think XLE is interesting sideways here. Oil's been ripping. XLE is not making new lows here. It's still kind of holding on to this support. So maybe if we do see some type of continued weakness in the broad market, XLE ultimately emerges as potentially a new leader. Again, speculating, doesn't have to happen, but it's something that's interesting here as it's not breaking to new lows and it's trying to hold in here. So something to pay attention to. Some of those individual stocks are starting to perk up as well. I've noticed a couple on the scans. XLU, again, nothing pretty here with this price action, but you can see on a relative basis, trying to hold up. The weekly chart still looks fairly ugly, all things considered, with the 8 and 20 period still bearishly aligned, hammering down against price. So again, doesn't look that pretty on a relative basis, though. It is a standout for this week, given everything else was crushed. When we start to look at some of the worst performing sectors here, XLB, materials, horrible look here, and in fact leading to the downside. You can see we have already clearly taken out the February lows here, and we are just on this parade lower. Again, notice the volume not so high here on this selling. You would expect as we start to crash, careful with the word crash, but as we continue to accelerate lower here and crash through support, you'd expect selling the volume to really be a little bit higher. Not seeing that, but still technically this thing looks horrible, losing this $57 level here. So again, XLB certainly in the bottom category, oversold. So yes, if you are looking for some tactical, very short-term reversion, I understand, I get it, I think that can work, but structurally that thing is as bad as they come in terms of individual sectors. Material, I mean, staples rather. This might take the cake, though. This is probably arguably even worse looking here as this continues to accelerate lower as well. Let's look at the weekly chart here, and we're even starting to lose the bulk of 2017's progress. So if we look here, in fact, let's see, I didn't really notice that on my first go around. So yes, we actually took out the 2017 lows here to the downside. So we almost have basically an outside bearish reversal yearly candle, which is pretty remarkable here for the staples. Again, it's March, right? So this is a yearly candle. Let's contain our comments here on the fact that that would actually hold true for the next 9 months. But again, I think the fact that we're losing last year's lows speaks volume to the outflow here in some of the staples. So certainly bearish developments there, material, staples, and financials. Really a dog here this week, 7% to the downside. Got to be one of the biggest moves. I didn't look back here for financials, but this has got to be one of the biggest down weeks. This is a 7.24% down move back here, and that was the start of 2016. But it's been a while since we've seen that type of move. Again, volume not so high, but this is a weekly chart of financials here, and just take a look. We're basically making new lows here on the year, and we're breaking through support, breaking through trend line, and moving averages extended to the downside. We're right at the lows, kind of the pivot reversal lows from the 9th. So again, maybe you get some type of reversion here early next week, but got to be nimble. The structural damage here is pretty immense from this week, and it's really just distribution there. Does not look like something that looks like I'd want to be, really sort of getting heavily involved in there for financials. But everybody's got their own strategy and time frame, so make sure you are aware of that. Finally, XLK. This isn't the bottom of, or the reason I want to bring up XLK is because this is actually still 4% above its 200 SMA. So yes, it suffered a good amount of damage this week for sure. 7.6% to the downside. This thing is again unwinding here with this consecutive gaps, just like the Qs. But to give you that perspective here, this thing is still 4% above its 200 period SMA. So from a longer term basis, this has had such a run that even the fact that it sold off 8% this week, it's still and was down or let's see, was it down? Yeah, it was down a little bit last week and then sold off 7.6% this week. It's still 4% above the 200 SMA, and even the semiconductors, which again got hammered this week, down 6.5%, is still, I think, 7% above its 200 period SMA. So again, it's had such a big run here on the weekly chart. I mean, this doesn't look horrible yet for semiconductors. This absolutely looks like a false breakout, but it does not look structurally horrible yet for semiconductors. But I think the risk is certainly all the way down to $97 for semis, which is another, 6 or 7% to the downside. Again, doesn't have to get there in one swoop. Not saying it has to go there, but giving you sort of that bigger picture perspective. So I think that's everything I had to cover. Sectors are a mess out there individually, similar to the indices. So careful out there, respect the risk, know your position size, know why you're owning positions if you're still, excuse me, in the long side and are comfortable with your strategy and all that good stuff. So thanks so much for watching. As always, you can subscribe to these to our YouTube channel. Tuesdays and Fridays is when they are published. So have a great rest of your weekend, and I'll talk to you next week.